This single signature is about to destroy Alex's financial future, while this simple handshake is about to make Emily rich. Meet Alex and Emily. They both have exactly $15,000 in savings today, but that is where the similarities end. Alex wants to look wealthy. He uses his $15,000 as a down payment on a $60,000 liability, financing the rest at 11%. He thinks he can afford it because he can make the monthly payment. Emily wants to be wealthy. She buys a 3-year-old car for $15,000 cash with an extended warranty. No car payments, no interest, and most importantly, no anchor dragging her down. Fast forward 5 years, Alex is going to lose nearly $60,000 in depreciation and interest. Emily, she's going to turn Alex's monthly payment into a $65,000 fortune. Today, I'm going to show you the math that car dealerships pray you never calculate. This is, Are You Car Broke? Let's dive in. Quick pause. If you're enjoying the video so far, please smash the like button and subscribe. It really helps the channel grow. Let's dissect Alex's deal. The dealership didn't sell Alex a $60,000 car. They sold him a payment. $978 a month. For a luxury vehicle, that sounds manageable to a young professional, right? Wrong. That sounds like a trap. Alex financed $45,000 at a brutal 11% interest rate. Here is the sickening reality. In the beginning, Alex is paying $412.50 every single month, just in interest. That is money vanishing into thin air. Over 5 years, Alex won't just pay back the loan. He will pay over $13,700 extra just for the privilege of borrowing that money. The real cost of his car isn't $60,000, it's nearly $74,000. But interest is just the noisy cost. Now meet the silent killer of wealth, depreciation. The second Alex's rear tires hit the public road, that car lost about 10% of its value. Luxury cars drop like stones. In 5 years, it will likely lose 60% of its value. Alex paid $74,000 for something that is now worth maybe $24,000. And the bleeding doesn't stop there. A brand new $60,000 car means significantly higher insurance premiums every month compared to a used one. Then, the government wants their slice. Because the car's value is high, you get hit with massive initial sales tax in the US, or VAT in Europe. And finally, registration. Whether it's higher vehicle property tax in the States based on value, or higher road tax in the UK based on emissions, new cars cost more just to keep them legal. Alex isn't driving a car, he's driving a financial anchor. Now, meet Emily. She's not falling for the dealership's trap. She's playing a different game. Emily buys a 3-year-old car. Why? Because the steepest part of that depreciation cliff. The previous owner already paid for it. Now, I hear you. The big elephant in the room, but won't a used car just break down and cost me a fortune? Let's be generous and say Emily spends a whopping $1,000 a year on repairs. That's a lot for a good car, but let's use it. What about fuel efficiency? Won't an older car guzzle more gas? Fair point. Let's assume Emily's car costs her an extra $50 a month at the pump. So, we add it up, $83 a month for repairs, plus $50 for fuel. That's $133 a month additional cost to Emily. But here is the magic. Alex is paying the bank $978. Emily, she takes that same $978, subtracts her $133 in costs, and has $845 left over. Every single month, instead of paying for Alex's depreciation, Emily is paying herself. She's investing that $845 in the S&P 500. Alex is financing a lifestyle. Emily is financing her freedom. Which one would you rather be? So, Emily has an extra $845 every month. She doesn't hide it under her mattress. She invests it in the S&P 500. This is basically buying a slice of the 500 biggest, most successful companies in America. Historically, it grows by about 10% a year. Let's watch what happens. Year 1, Emily has put away about $10,000 of her own cash. The growth, it's small, maybe $500 bucks. You barely notice it. Jump to year 3, she's saved over $30,000. But look at the growth, her money is now making serious money. The gap is widening. But year 5 is where the magic happens. This is the hockey stick. The interest is generating massive interest. Let's look at that number. Over 5 years, Emily only put in $50,700 of her actual cash. But her account balance is over $65,000. That is nearly $15,000 in free money, just for waiting. And this is the double whammy. Alex didn't just lose money on a depreciating car. He lost the growth on the cash he paid the bank. That massive gap between them, that's called opportunity cost. So, the lesson is simple: don't be Alex. You don't need to drive a wreck, but you also don't need to set your money on fire. Let someone else pay that massive depreciation bill. Here's your new rule of thumb: make it your financial goal to buy a reliable, used car with cash. Stop financing liabilities. Start buying assets. Alex's car is a liability. It takes money out of his pocket. Emily's investment is an asset. It puts money into hers. Which side do you want to be on? Now, have you been saving in cash and are looking to transition safely into equity investing, just like Emily? Watch this video right here. I'll show you how to get started.